I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Hello everyone and welcome to Ask Rob and Rob, a still quite new podcast from, yes, Rob and I. So, welcome again to another great episode. It's a great episode because it's a great question. We don't know who this person is because they don't leave their name. So, Rob, how do you submit a question? What's the best way to go about it?
Well, there are two ways, both of which just involve leaving us a voicemail. So, you can give us a call on 013 808 0035. That's 013 808 0035. That's just on your normal telephone rate. Or you can go to thepropertyhub.net/podcast and you'll see a link to leave us a voicemail through your computer. Either way, really easy. Just give your name, which today's caller doesn't, and so we know who to give a shout out to, and then ask us your question.
And this week's question comes from Mystery Guest, which sounds pretty cool, but that's just because they forgot to leave the name. So thank you, Mystery Guest. Here's your question.
Okay, so some people claiming that shares are a better investment. Some people prefer property. I think you can probably guess what our preference is, but what are some of the factors involved?
Well, the first thing that should be said is people tend to manipulate the data to prove their point. If you type into Google, for example, shares versus property or stocks versus property or property versus shares, whatever you type, there'll be articles that come up because it's an age-old argument. People have been having this one for a long time. This isn't the first time it's been debated. But what makes me really chuckle, and actually sometimes gets me annoyed, is these articles that are heavily weighted to one side. There are merits in both, and we'll discuss them. For example, I've seen an article where they started the data point from 1989. It was an interesting year to pick to prove that shares were the better prospect, because months later, property crashed and took a long time to recover. So they picked the peak of the property market as their data starting point. Now, if you pick the top of a market, the rest isn't going to look great. It's like stocks. If I'd picked the previous peak, maybe around the tech boom, if I picked that as the starting point and then it's crashed, recovered and gone back up since, it's still not an ideal point. So that's the first thing to be aware of, is when people use data to back their arguments, question the data. Sometimes people just accept the data, but you want to be questioning that data. Now, why would you go for property? Well, property you can leverage. Now, shares, some people say you can do a bit of leveraging, but for most people that's far too advanced and far too risky. But leverage in property is very common. You can go and get a mortgage. Most people can do it pretty easily. Use a mortgage broker, get 75% of the property paid for by a bank, and you only put 25% down. And therefore, the gains you can make by using leverage are vastly multiplied. We've done a podcast on leverage, so make sure you check that out. We'll link to it in the show notes. But the leverage is a key core concept you need to understand. And also property generally, not all the time, but generally offers higher returns. So yes, you can get dividends through shares, but on the whole, property tends to give a better return than shares. So that's another plus point for me for property, and that's where I focus my attention there.
Yeah, and I've got a couple of other plus points to throw into the mix. We're going to try and not make this horrendously biased, but a couple of things to bear in mind. A big one, I think, is that you could add value to a property, but you can't add value to a share. So a share in a particular company is worth whatever it's worth, and the value of that will change based on sentiment and based on how well the company does. And there's nothing that you can personally do about it unless you have a massive shareholding and you can actually influence what's going on. With a property, though, you can add value to that and you can basically create equity for yourself. So if you buy something that needs some work, you spend £10,000 on it and you add £30,000 to the value of the property in the process, then you've just created £20,000 out of thin air. And that's something that you could never do with stocks and shares. Another reason that I think property appeals is that an individual share in a company could go to zero. The company could collapse, something horrendous could come out, the value could absolutely plummet by 90% or more. And it has happened, it does happen. With property, that's never going to happen, in the UK at least, because it's underpinned by fundamentals. As well as it being an investment, it's somewhere that people need to live. Everyone needs to live somewhere. And therefore, if the value starts dropping, I'm not saying that the value won't drop by 30% over a few months. It can happen, and it has happened, but it's never going to drop to zero because there are fundamentals at play. So there's less volatility, basically. Property prices go up and they go down, but they're not going to go in a jagged line up and down like crazy from day to day. they are generally a more stable investment.
And I think this links to the final point is property is just something that most of us understand. We've all lived in a property. So, we understand what's involved with the living part. So therefore, if we rent it to someone, we know what their basic needs are and what they would want. We know different areas. It's easy to research areas if you're not familiar with them. So property is comfortable for a lot of people over shares. The inner workings of a boardroom or board meetings or shareholder meetings and everything that goes behind it and the balance sheets and the cash sheets, looking at all that can be really intimidating for people and put them off. But there are positives for shares, and it's important to point them out. First of all, shares are liquid. If you need to sell your property, you can't do it at the push of a button, which you can do with shares. So if you suddenly need to get hold of cash quickly and your money's locked in predominantly property, then that's not going to be an instant win for you. You may need a few months to get your money out of a property. And if you need to do it really quickly, get the price down and not realise the full value of it to just for a quick sale. So that's a plus point for shares and a negative for property. Also, it's important to point out that people have done very well with shares. Those who spent their time and effort to learn and understand it have made a success of it. There's a reason there's a debate. It's because people have done well in both, and that's why it's a debate. If it was a clear winner, property, then the debate wouldn't even happen. Now, we feel it is more in favour of property than shares, but we would, wouldn't we? And also, diversification is easier with shares. So you can invest your pot of money in different types of companies in different sectors. With property, you can diversify a little bit by investing in different areas and different types of property, but not as much as you can do with shares. So there are definitely plus points with shares. So overall, yes, we are definitely in the property camp, and yes, we believe there are more positives for property, and that's why we'll continue to invest the majority of our wealth. But there is an argument for shares as well. I don't know, Rob, you've got part of your wealth in shares as well, but still the majority of it is in property.
Yeah, I think if you're going to choose one big plus point for either side, then with shares, diversification is the big one. If you've got one property and for some reason everyone decides that they don't want to live on that street anymore, then you're in a bit of trouble. I wasn't being entirely fair earlier when I said that an individual share can go to zero, because yes, it can. But you can easily have a share portfolio built up of shares in multiple different companies, so you're averaging it out and there's less risk overall. But then if you're choosing the big plus for property, it's that leverage. And it's when you bring leverage into play that you can see why property makes such superior returns. As we said, we have done an episode of the Property Podcast on leverage, and we'll be linking to that in the show notes, which you can find at thepropertyhub.net/property advice. So this is the kind of question that comes up when we do quick fire questions at the Property Hub Summit events. We always, before people come along, we ask them to list out not just what they want to know about their specific situation, but any kind of general questions that they've got as well. We get all those questions together and we make sure that we blast through all of them in one session. So every question that people ask coming in, they go away knowing the answer to it. And this is quite a typical one that I think we might have even discussed before. But if you're interested in the idea of the Property Hub Summit, coming along and spending a whole day with us, learning from us and your fellow investors, it's really easy to find out more. All you need to do is text the word SUMMIT, that's SUMMIT, followed by a space and then your email address to 88802. So that's text the word SUMMIT, followed by a space and your email address to 88802, and we'll be in touch.
So remember, you've got the Property Podcast coming up on Thursday, which I'm sure will be another cracker. We'll be back on Ask Rob and Rob next Tuesday. So until then, have a wonderful few days. Bye-bye.
Bye.